Hello, this is Japanese Economic Review Channel. Today, we review the June 2026 Kinki Region new condominium market. The defining theme is a historic divergence. We are seeing intense market friction where supply is plummeting while prices are hitting record highs. Let's explore the reality behind these numbers. June supply plummeted to 710 units, a 53.7% drop from May, and the lowest June level since 1977. Paradoxically, the average price soared to 64.21 million yen, the highest for June since tracking began in 1973. This extreme supply restriction alongside price inflation highlights a severe market distortion. The cost to enter the market is accelerating. Average unit prices jumped 23.4% year over year. Meanwhile, the price per square meter rose by 8.8% to 1.023 million yen. This disparity suggests a shift towards premium, larger footprint properties, rather than across-the-board inflation. How are buyers reacting? With deep hesitation, the contract rate fell to 62.8%, dropping below the healthy 70% benchmark for the second consecutive month. Notably, there were 0 same-day sellout properties in June. Consumers are clearly taking a wait-and-see approach amid soaring costs. Geographically, supply is heavily centralized. Over 67% of new units are in the greater Osaka area, with Osaka City alone accounting for 44.1%. As overall market volume shrinks, developers are retreating to established urban cores, leaving peripheral areas with minimal new supply. Broad averages mask extreme local volatility. Osaka City remains highly liquid with a 79.2% contract rate. Conversely, the adjacent Osaka Prefecture stalled entirely, plummeting 59.2 points year over year to a 30.1% rate. Kyoto City saw the highest prices, reaching 72.24 million yen. Analyzing by layout, family-oriented 3LDKs make up the core market at 439 units, but their contract rate stalled at 55.5%. The overall market rate is actually being artificially propped up by the rapid absorption of compact 1K and 1LDK units, which are heavily favored by investors. When we remove investment properties, the burden on true homebuyers is laid bare. The actual supply for end users is 620 units, and their average price approaches the 70 million yen barrier at 69.70 million. Consequently, the true end-user contract rate drops firmly into the 50s at 59.5%. Looking ahead, unsold inventory stands at 3,245 units, roughly 700 more than last June. The market faces a crucial test in July. Supply is projected to roughly double to 1,500 units. The key question is whether current demand can absorb this incoming backlog. In conclusion, we are at a crossroads. Buyers are resisting peak pricing, hitting an affordability ceiling. Demand is hyper-localized, separating liquid urban cores from stalling suburbs. With rising inventory, developers will face mounting pressure in Q3 to adjust strategies or offer incentives. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.